Most grantee financial problems are not always surprises. I can say that they're always predictable. So they kind of show up in financial data 6 months to a year before they surface as a missed deliverable, just like I was talking about in my last video, because it may come out like a late report, a conversation with a program officer about a budget variance that nobody can actually really fully explain. And most of the time, the reason they feel like surprises is that the monitoring framework that the foundations use, especially during the design phase, is not designed or dedicated to detect any early warning signals. So they are sometimes mostly designed to confirm compliance after the fact, especially during the due diligence, so that when a grantee submits a narrative report and a financial report that both say that the grant is on track, the monitoring process typically moves on. What the process does not usually include is an analysis of whether the financial data itself is showing patterns that would probably suggest that the grant will still be on track in 6 months. So today we walk through the 5 specific signals, things you can observe in a grantee financial data during the grant period that reliably and predictably can show you capacity problems before this can actually arrive in the form of late reports or even delayed reporting. So each of these signals can be detected through information that most funders already collect or could easily request for, but none of them actually require any kind of forensic or detailed in-depth accounting review to know. So let's move into the first signal. The first signal in this is the timing and consistency of the grantee's month-end financial close. And in my initial conversations, I really spoke quite extensively about some of the problems that make it impossible for organizations to have smooth and timely month-end close. So you find that organizations with well-functioning financial systems, they will close their books within 7 to 10 business days of the month end, and they will be able to produce financial reports from that close. Then we find that organizations with struggling financial systems, they will close their books, but it will always be late, or maybe they have inconsistency in how they do it, or sometimes they don't even do it on a month-by-month basis. And many of the times, their financial reports are produced by pulling transactions directly rather than from a formal closing process. So it's always an ad hoc. Every time somebody needs a report, there's an ad hoc process of having to pull that report for them. But why does this matter for a grant relationship? It does matter because when a financial report deadline arrives, the quality and the accuracy of the data in that report is almost entirely determined by the quality of the underlying closing process. For example, if the organization has been closing on time every month, they are reconciling accounts systematically, and they are reviewing reports against budgets regularly, the grant financials report is essentially an extract from an already reconciled system. But then if the organization has not been closing consistently, the grant report definitely is being constructed from raw transactional data under deadline pressure, and the risk of errors, misallocations, and even variances that nobody can explain is definitely substantially high. So how can you observe this signal as a person sitting on the other side of the table? So ask as part of your due diligence or your early grant relationship with the grantee, what the organization's month and close timelines looks like, how consistently it's met. And most finance directors in well-run organizations can answer this question precisely and with some pride. But finance directors in struggling organizations, they tend to give vague answers or answers that suggest that the close happens when it happens. So the quality of that answer in itself is your very first diagnostic tool. The second signal is the pattern of budget versus actual variances across multiple reporting periods. So every organization will have variances between budgets and actual spending. And actually, that's what is expected. But that is not the signal. The signal is the pattern of how variances are distributed, how they are explained, and whether they accumulate over time or actually resolve. So an organization with strong financial management tends to have variances that are relatively small, evenly distributed across budget lines, and are accompanied by clear explanations tied to specific operational decisions. A hire that was delayed, for example, a program activity that was scheduled, a procurement that probably came in under budget. These explanations are specific and the variances are tracked forward. On the other hand, an organization with financial management problems tends to have variances that are concentrated in a small number of large budget lines, particularly personnel and indirect costs. That's always the catch. That grow over the course of the year rather than resolving. So this kind of variances, they keep growing and they keep growing, and they're not resolving with every reporting cycle. And that the way that they are explained is never clear, because we find that this kind of organization, they have these variances that they grow over the course of the year rather than resolving them, and that they are unexplained in terms of conditions and also decisions. So sometimes, revenue came in differently than expected for them, costs were higher than anticipated. The explanations describe circumstances rather than the choices, which actually signals that the budget is not functioning as a management tool. It's actually being just used as an approval document and not a control document for what it should be. So when you are reviewing a grantee financial reports, look not just at whether the cumulative spend is on track, but at where the variances are sitting and whether the same lines are varying in the same direction across consecutive reports. Persistent underperformance on personnel lines, for example, this one can signal maybe a staffing problem that will eventually affect program capacity. And sometimes persistent overperformance on indirect cost lines can signal an allocation methodology that is not functioning as designed. Then the third signal is the age and the composition of the organization's outstanding grant receivables. I talked about how to read about the balance sheet in my initial video on this series. So when you look at grantee's balance sheet, the accounts receivable line typically includes amounts owed from maybe government grants, foundation grants, and sometimes fee-for-service contracts. What the aggregate number does not tell you is how old those receivables and how many of them are generally collectible in the near term. An organization with large aging grant receivable is in a situation where significant revenue has been recognized in the financial statements but not yet received in cash. So if that receivable is from, let's say, a government contract that is behind in its payment schedule, or from a foundation grant that requires a deliverable before the report or before the final payment is released, the organization may be operating against financial projections that are more optimistic than the cash position warrant. So you probably need to pay attention to that. So from a portfolio management perspective, this would matter, especially if I was the one looking at it. This would matter to me because an organization that is waiting on significant outstanding receivables from other funders may be less financially stable than its net asset position suggests, and may be more vulnerable to cash flow pressure during the period of my grant or of the grant that you're overseeing. So asking a grantee about their receivables aging as part of probably a mid-grant financial conversation is a reasonable portfolio management practice, because well-managed organizations will have this information readily available. Organizations under cash pressure will often confirm through the conversation. Then the fourth signal is the turnover in the finance function, particularly at the finance director or at the controller level. And this sometimes people think that it doesn't count, but you see, looking at a finance function turnover, that is one of the most reliable predictive indicators of a grantee capacity problem. And it's one of the least systematically tracked in a grant monitoring framework. When a grantee, for example, loses a finance director mid-grant, several things happen simultaneously. First of all, there's the institutional knowledge of the grants and the budget structure, the reporting methodology, and the funder relationship that walks out of the door. So the incoming finance staff, whether interim or permanent, needs time to understand the grant conditions before they can manage compliance effectively. And the period between departure and replacement is often when allocation errors actually occur, because there is reporting delays and compliance gaps accumulate because people are just trying to keep the lights going. So the reason this matters from where I sit is that for portfolio management is that finance function turnover at a grantee is often a symptom of organizational stress that has other dimensions definitely. Organizations under financial pressure, governance stress, or leadership conflict often see finance staff leave very fast because finance professionals have visibility into problems that other staff do not have, and because their skills are portable in ways that make departing easier than staying in a difficult environment. Most of the time they actually choose the latter. So let's look at a practical implication. In early conversations with new grantees, ask directly about the stability and tenure of the finance team. Ask how long the current finance director has been in the role and what the organization's pattern of finance staff tenure has been. The answer will tell you something about the organizational environment that the financial statement cannot show you. Then the fifth signal is the accumulation pattern of deferred revenue relative to the organization's program delivery capacity. So deferred revenue in a non-profit, if you can just go quickly, represents the grant funds received but not yet spent on qualifying activities. So there's some level of deferred revenue is normal and healthy. Grants are often received in advance of the activities that they fund, and that's normal. And holding those funds in the balance sheet while the program work proceeds is actually a standard practice, so nothing off. What becomes a capacity signal is when deferred revenue accumulates faster than the organization's ability to spend it down. This pattern suggests that the organization is winning grants at a rate that exceeds its current program delivery capacity. The financial position looks strong because the cash is in the door. But the future program delivery obligations represented by that deferred revenue are substantial, and if the capacity to deliver does not grow proportionally, the organization will face a choice between under-delivering on program commitments or spending funds in ways that are not fully compliant with the grant conditions. So for a portfolio manager, this signal is particularly relevant when you are considering a significant new grant for an organization that already has a large deferred revenue balance. The question to ask at this point is not whether the organization can absorb the new funding, but whether their current program staff, systems, and the management capacity can deliver on the combined obligations that the deferred revenue presents. So these 5 signals are not a complete due diligence framework. They are a set of indicators that a portfolio manager can observe and track throughout a grant relationship using information that is either already available in standard financial reporting or can be requested without creating significant additional burden for the grantee. The purpose of monitoring the signals is not to be on the bad side with the grantee or to treat every financial problem as a cause for concern. The purpose is to be able to have informed, early, constructive conversations when a pattern suggests that something may be developing. Because early conversations about capacity constraints are actually manageable. Crisis conversations offer a major compliance failure and are expensive for everyone. So in the third video this week, we go into the program expense ratio specifically because it is the metric that the sector has elevated most prominently, and it is also the metric that most reliably misleads both funders and the public about what organizational health actually looks like. That one is worth understanding in detail. So please subscribe so that you stay tuned and be informed when that one comes out. Thank you for watching, and this is the Farm Framework.